Let me show you how you can actually replace your active income with passive income using strategic ETFs that will pay you with income year after year after year. Starting with category number 1, the broad United States dividend paying ETFs. I'm going to talk about SCHD and VYM. As a disclaimer, I am personally invested in both of these and I don't recommend what I do to anybody else. SCHD is an ETF created by Schwab. VYM is an ETF created by Vanguard. These are two of some of the largest asset managers, money managers in the world, but the whole idea behind both of these ETFs is very similar, is that these are investing in United States companies that are paying out dividends, and they're working to specialize in these funds, invest in those United States companies that are paying out dividends and will hopefully be working to grow the dividends and the profits over time. And at the time of recording this video, SCHD is paying around 2.4% a year. VYM is paying around 2.6% a year. So this is giving exposure to United States companies that will hopefully grow in value, but are also paying out dividends. There's also an international version of both of those ETFs created by Vanguard and Schwab. Vanguard's international high dividend ETF is VYMI and Schwab's is SCHY. And as a disclaimer, I'm personally invested into this ETF right here. Now, international funds and stocks are interesting because a lot of companies outside of the United States don't just benefit when the company grows, but they can also benefit when the country is growing. And so there are certain countries and companies that are in the world that have the potential to grow a lot faster than those inside of the United States, because not only is the country growing, but the company is also working to innovate inside a fast growing, fast developing, emerging market, which can create more potential opportunity. But that also means it comes with more risk. So you'll see that these funds have higher yields, higher dividends, but there's also more risk associated with it, but more potential upside. You can see the value of the fund grow even faster and the dividends grow faster, but it also has the same risk to fall just as fast. So VYMI is paying out around 4.1% a year. SCHY is paying around 3.9% a year at the time of me recording this video. Then we have dividend growth ETFs. And this is an interesting one because when most people talk about growth stocks or growth ETFs, they're generally talking about those smaller companies, the smaller stocks that are working to grow the value of their stock, the stock price, as fast as possible. Here we're talking about something a little bit different. We're talking about investing in the companies that are working to grow their dividends, their income payments faster. And I'm going to go over a couple of ETFs here. One is NOBL Noble, the other is REGL. And these are focused on companies that have been working historically to increase their dividends in the past. So NOBL invests in S&P 500 dividend aristocrats. What that means is NOBL is only investing in dividend paying companies that are in the S&P 500, meaning they're part of the 500 largest companies in the stock market, but they must have also paid out and increased their dividend every year for the last 25 years or more. So it's a pretty exclusive club here, but you can start to see that they're focused on the companies that have been regularly increasing the dividends. The alternative is REGL. This is an ETF that's investing in the mid-cap 400 dividend-paying companies that have increased their dividend for at least the last 15 years, meaning it's one of the 400 mid-cap companies in the United States on the stock market. These are now not the biggest, but kind of those medium-sized companies. So they have the potential to grow a little bit more faster, a little bit more risky than the largest companies. But now each one of these companies has worked to pay out and increase the dividend for the last 15 years. So these are companies that have worked to find those companies that are more of an exclusive club that have been consistently increasing the dividends and have the potential for more dividend growth. Now, let's talk about REITs, because if you've been following my channel, you know that I like talking about real estate. And real estate is a great investment for cash flow. The problem is it takes more work, it takes more capital, it takes more headache to actually go out and buy rental properties. If you don't want to do that, one alternative is to invest in a REIT. A REIT stands for a real estate investment trust, and essentially what you're doing is you're investing in a company that has exposure to real estate. So instead of actually investing in the real estate, you're investing in the company that's buying the real estate. And I'm going to go over two different examples here. SCHH and MORT. They're two very different style of REITs, so I want to talk about them differently. SCHH is an ETF that invests in United States property owning REITs, meaning this only invests in companies that are investing and buying property in the United States for income. Now, REITs are unique because they follow something called the 90% rule, which essentially says that the REIT has to take 90% of the taxable income, essentially their profits, and give it away to the shareholders in the form of dividends. And that's why some people like to invest in REITs for their income because, well, they're generating rental income, they pay for the property expenses, and then they distribute 90% of the income in the form of dividends. So this is investing in companies that are actually buying those rental properties, whether they're office or apartments or anything in between. MORT is a little bit different, M-O-R-T. This is investing in mortgage REITs. So this is not investing in the companies that are buying the properties or buying the land. This is investing in the debt on those properties. Very different. This ETF doesn't invest in the companies that are owning the real estate, they're only owning the debt, and this is paying a 12% dividend at the time of recording this video. Now you might hear that and say, oh my God, Jaspreet, 12%, that's crazy. Why don't I just dump all my money into that? That's gonna give me some great returns. Well, more return comes with more potential risk, right? Well, and that's what's going on here. Mortgage REITs are much more risky. They're much more volatile. You see them go up and down, which is why whenever you do your investing analysis, make sure you don't just look at the dividend number because it can be extremely deceiving. Now, for some people, this might be a good investment for their portfolio. For others, it will not be. I want you to understand that when you do your analysis, looking at the dividend number by itself is never, ever, ever enough to decide if it's good for your portfolio or not. Always look at the underlying asset. What are the actual companies that you're investing in, and see if that's actually a business that you'd want to be a part of or want to own. And number 5 are interest-paying ETFs. So these are going to be the most different than everything above because these ETFs are not actually investing in stocks or companies. These ETFs are giving you exposure to interest. And more specifically, what's happening here is these are short-term treasury ETFs, meaning you can lend money to the United States government. And in exchange, the government will pay you with interest. And the nice thing about that is that the United States government is considered a risk-free investment because the United States government will always pay their bills. Now, that doesn't mean they always have the money to pay their bills because they generate money from taxpayers and tax dollars, but they have the ability to pay their bills because if they don't raise taxes, they can just get that money printed from the Federal Reserve Bank, so they have the ability to pay their bills. And with these ETFs, you're getting exposure to the short-term treasuries, and you get the interest without actually having to go and lend money to the United States government because these are ETFs you can trade on the stock market like any other ETF. You can buy and sell it whenever you want. And the other benefit is with the interest from these ETFs, you are generally not subject to any state or local taxes because it's interest from the United States government. So a couple benefits there. But the way it works here is you have SGOV and BIL. Both of these are short-term treasury ETFs. And now you're not actually going to see any appreciation in the value of your investment because with all of these, the goal is number 1, you're going to see the value of your investment go up, but also the dividends would go up. Ideally, that's how it would work in the best case scenario. With these, it doesn't work like that because the price of these ETFs doesn't change. The only times it changes is when it pays out the interest, and it pays out the interest monthly. And so you'll see the value of the ETF drop by the amount of the interest because you're really just buying something that's paying you interest, and the value of your investment is not changing because it's backed by treasuries. And if the United States government were to default, then yes, the price of these would probably drop, but that would create a whole lot of other problems. So the prices of these are backed by United States treasuries. You're generating interest. The value of your investment is not going to go up, but the interest rate that you get can change. And it's going to vary depending on where interest rates are. So if we do see interest rates get cut, then the interest that you're going to be paid would also go down as well. But if you wanted to generate some interest and you don't care about the value of your investment going up or down, this could be a way for you to generate some interest and not actually have to go through the hurdles of lending your money to the United States government. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.